Alrighty guys, so in today's video we're going to be going through a high probability model that you can use in any session. It could be London, it could be New York, it'd also be the PM or AM session in New York, but it works in all sessions. I'm going to show you an example from the London session and let's get straight into it. So sometimes this happens, right? You want to trade silver bullet, if you're trading the London session, silver bullet is from 3 to 4 o'clock. But what happens in this time frame? Nothing, right? This is like a scalper's market. Yes, there's opportunities to go long. Yes, there's opportunities to go short. And I'll make another video on that. But if you're looking at a macro perspective, then have a look at the larger time frames, right? So I encourage you to have a look at like the 15-minute time frames, right? Have a look at the 5-minute time frames just to see what price is doing and how it's behaving, right? Now, every single session, if you're trading the London session that is as well, you should be marking out the midnight open price, right? That is a really important price. Now, sometimes I'll just do that with a dotted line. That's the first thing you got to do. Second, what you're looking for is you're looking for some kind of accumulation, right, at midnight open, right? You're looking for accumulation at midnight open. Then what you're going to do, guys, is you're going to map out any 15-minute fair value gaps that you see that are nearby. So there's your 15-minute SIBI, and I'm going to chuck that in here too, just so you guys can see 15-minute SIBI. In other words, a bearish fair value gap, right? And also, just so it's a bit more clear, there's this 15-minute fair value gap here too, right? So we've got this 15-minute SIBI and we've got this 15-minute bullish gap or busy, right? There's two ways to approach this, right? There's two ways to approach this. Number one is you use the power of three, accumulation, manipulation, distribution, and that's on a small time frame. Or you see this as the whole accumulation phase, this as the whole manipulation phase, and this as the distribution phase. So the power of three, just like other concepts, guys, is a fractal concept. We're going to talk about the bigger concept today and how you can use this as accumulation, manipulation, and then distribution, right? Talking about potential entries into certain trades and how you can use macros to frame a high probability trade. So let's now zoom in, right, to price action right here when we're in that 15-minute sell-side imbalance. In order to do this, guys, I go into the 1-minute time frame. So a lot of people have been asking me, when do I use the higher time frames, right? The 15-minute is the bread and butter for me, right? I like to see imbalances on that. I like to see fair value gaps, and I like to see liquidity points. So that swing high there, and I'm going to zoom in a little bit, that there is a liquidity point right here, right? It's a liquidity point. Above that liquidity point, you've got this 15-minute imbalance. Again, all I did was mark out liquidity points and I marked out an imbalance, right? We're sitting in this one, right? We pushed up, we manipulated, we rated liquidity, and we tapped into a fair value gap. So what you're looking for is this. You're looking for a rated liquidity plus fair value gap on a higher time frame. That is the pre-narrative framework that you need to execute using this strategy. Extremely high probability. To increase that, you're looking for the raid to occur from the power of three. So in order to execute the full strategy, you need an understanding of what the power of three is. If you haven't seen my other videos, I might put one at the end here in reference to the power of three video I made recently, so check that out. But you need an understanding of the power of three and also fair value gaps. Higher time frame for me is anything on the 15-minute, the 30-minute, the 1 hour, the 45, anything 15-minute and above, right? How high do I go in terms of time frames? Ideally, no more than 1 hour. Otherwise, the imbalance can be too big and there's too much range. So 15-minute often does the trick. So that's the first thing. That's what we're looking for as our framework, right? Second thing, let's have a look now at this 15-minute sell-side imbalance. And let's map out the macros. Again, macros, I've made many videos on this and I will continue to make them, but 10 minutes before and 10 minutes after every single hour. So 4:50 to 5:10 here is the focus. You might say, why is that a macro? Macros deliver price in an important way. And this is the last macro in the London open session. London open session is from 2 a.m. to 5 a.m. So this is the last macro, right? So we rated liquidity, but look at the reaction after we rated liquidity. Do we progressively move higher? No. We automatically, right, form an order block, and then we automatically form this inversion fair value gap here. So price now is starting to develop PD arrays. Price is now starting to develop PD arrays. It's now starting to develop bearish PD arrays. And this is exactly where I entered from. So have a look at this. This sell side imbalance, right? This is a SIBI right here. And look at what that lines up with. So this is the unicorn model, right? These two down close candles are your breaker block. I'm going to outline that with two black lines here. So let's outline this. Entry came right here. Stop loss was above the inversion fair value gap. We'll talk about that. And the take profit was a 1 to 2, or in other words, this bullish gap right here. Now, the price continued to run. The price continued to run. You might be like, well, why didn't you hold it? I don't need to hold it, right? When you're taking small trades like this, fixed risk to reward, or you're just looking for a certain amount of handles, it's not necessary to hold the trade. Plus, we're towards the end of the session anyway, and I wanted to take advantage of this macro. So I was entering during the macro, anticipating that the macro would run for liquidity, right? So the macro does one of three things, right? Either raise liquidity, it creates an entry, creates a market structure shift, or it does all three. And let's talk about this example, because in this example, it does all three. Extremely high probability setups. So we raise liquidity during the macro. We have an inversion fair value gap during the macro. We create a breaker block during the macro. We have an entry during the macro. And we hit our take profit during the macro. That is what I call an A++ setup. And again, it comes from this framework right here. So this particular day, right, we raid liquidity from the power of 3. Again, just going back briefly to what that looked like on the 15-minute time frame so you guys can see. Accumulation, manipulation to sweep liquidity and tap into an imbalance, and then distribution. Distribution distributes at minimum to the bottom of the accumulation period, but in this case, all these sell-side liquidity points. So this entry as well, this is a part of the distribution move, right? Use the macro to frame it. So this is the narrative. We've got a power 3 raid, a fair value gap, and a high time frame. Then we have a macro entry and a macro exit, which is beautiful, right? And you can see how it runs perfectly during that macro, right? Then we accumulate, we move down. Eventually, we take out all the sell-side liquidity. You know, right? You know that this is manipulation because the manipulation move is much smaller than the distribution move. And again, this is on the larger time frame. So I will make another video and I'll post that later in the week about the other move that you could have taken advantage of to the upside, which is a power 3 on a smaller time frame. But on a larger time frame, you can see we muck around here, we accumulate in this tight range from 2 o'clock, right? Look at this, 2 o'clock all the way till 4 o'clock, the whole time frame. Then we push up aggressively, suddenly, we raid liquidity, tap into that imbalance, and then we sell off. So this, guys, is a really high probability entry model, right? Accumulation is the power 3, manipulation, right? And then when you manipulate, you tap into a high time frame PD ray. And then after that, you distribute. You use time as your factor or to your benefit. So where you enter should be during a key time, silver bullet, during a macro, and then you target what you need to in terms of risk to reward. So hopefully this makes sense. Bit of a quicker video, guys, but just a video here today on how to execute high probability trades. And this is one example of how you can do it. So hope that helps. If you've got any question, leave them in the comments below. And until next time, I'll talk to you guys then.